we are going to explain and then demonstrate very briefly how to maximize the cash value on any whole life insurance policy. Let's get into it. So with any whole life insurance policy, when I set up a policy, what many are not aware of is we can actually choose where our money goes. We will refer to this as the policy design. So if you are a consumer interested in life insurance, if you're focusing on the cash value and you want to understand how to maximize your cash value, if you're giving them $1, how do you get the most juice, the most cash possible out of that dollar? This is how to do it. So at the end of the day, when we set up a policy, there are two primary areas in which our money can go. We have our premium, and then we have our PUA rider. I'll often refer to the premium as the insurance expense. Let's call it the initial insurance expense. You'll see why in a minute. And I will refer to the PUA rider as a cash dump-in. So the first thing to do is understand the relationship of these two areas, because if you're going to give the insurance company $1 to build your policy, you want to maximize cash value, your money, that dollar, can go toward the premium or towards the PUA rider. Here's how they work. So with any life insurance policy, I have my cash value and then I have my death benefit. If I'm going to pay, let's simplify here, $1,000 per year into the insurance premium and $1,000 per year into the PUA rider, the cash dump-in, how will they function? Meaning, what will my cash value and death benefit look like as I allocate dollars towards these areas? Let's demonstrate. Dollars I pay towards the base premium, i.e. the insurance expense, will function like this. I will often see zero of this money, this $1,000, show up in cash value during the first and second year with most traditional policies. So if I give them $1,000, I'll see zero in the first year, maybe a little bit in year two, depending on the company and policy, but typically the first 2 years I have zero in cash. The reason why is the life insurance company is overcharging me for the death benefit up front. That's where a life insurance company makes the bulk of their money. They overcharge me for the death benefit, the cost of insurance in the first and second year. Now, dollars that go towards the premium piece, dollars that go towards the PUA rider piece. If I pay $1,000 in, I will see approximately $1,000 show up in my cash value immediately. Now, PUA stands for paid up additions. What this means is when I make payments to this rider in a policy, this does purchase me paid up additional life insurance. Why it is paid up is because this piece of the policy, the PUA rider, is very flexible. I can adjust the amount up and down where the base premium is fixed for the life of the policy or however long I can pay into it. So back to the PUA rider. I pay $1,000 in. This is money I have access to right away. This is money that begins to yield the guarantees right away. This is money that begins to yield the dividend right away. Dividends and the surplus rate. This is the key to accelerating the cash value growth on any life insurance policy. So when you hear of large corporations, big banks, the 1% wealthy individuals, or anyone that has a high cash value life insurance policy, high cash value, meaning they've got money right off the bat, they break even early, things look good. What they're doing is maximizing this piece. This is the only way to get high, strong initial cash values. So the question we often get is, okay, Steve, I get this. I don't really care about the initial death benefit. How do I put 0% of my payment into the premium and 100% of my payment into the PUA rider because I want to maximize the cash? We get that question frequently.
Well, we cannot go quite that aggressive for two reasons. Limitations. There's two limits to be aware of. The first is the insurance company's limit. Now, when it comes to the insurance company, different companies have different limitations. Some companies, this all has to do with wherever I set my minimum premium, some companies will allow me to pay in an additional 3 times my base premium into PUAs per year. What that means, for example, is if I had a $1,000 base premium, some companies would allow me to pay in another $3,000 into PUAs for a total of $4,000. Some companies will allow me to 10x my minimum base premium. So what that means is if I had a premium of $1,000, they would allow me to pay in another $10,000 per year into PUAs. Some allow my total payment to be 10x. That would require or allow for only another $9,000 in PUAs. And then some companies, a few smaller ones we've seen, will allow you to pay any amount into PUAs. There's no limitation or no cap based off of the insurance company limits. So the first limit to be aware of is the insurance company limit. And then the second limit to be aware of is the IRS limit. So we've got this term, this MEC or MEC. It stands for Modified Endowment Contract. So a huge benefit and drawing factor, what draws people in to cash value life insurance is that if it's all set up right, it's tax-free. I can use it tax-free if I do everything properly. With that said, any life insurance policy can become classified as a MEC. If it does, I have to deal with taxes in respect to the cash value. Now, my payments into a life insurance policy cannot be deducted. So how the taxes will work are somewhat similar to a 401k. Here's exactly how it works. The growth is still tax deferred. TD, tax deferred. However, when I access money, I have to deal with ordinary income tax in respect to the gains. And if I'm under age 59 and a half, I have to deal with that ugly 10% penalty tax. So to sum it up, I do not want to MEC. I don't want a MEC to occur on a life insurance policy. It ruins the plan, messes everything up. So back to the limits. We got here by first talking about the insurance company limitations. What is the IRS limitation? Well, every policy will have what's called a MEC limit. Let's put it right here. Now, the nice thing about this, many are not aware of it, is we can actually set that MEC limit wherever we want with a life insurance policy. You'll find that the MEC limit has a direct relationship to one's age and total death benefit on a life insurance policy. This is, call it the measuring stick that the IRS will use to determine if a life insurance policy will be viewed as life insurance in their eyes or a pure taxable investment. So when we custom design a policy, if someone states, hey, the death benefit, I'm covered there, or I'm not as concerned initially, I want to understand how to maximize the cash value, what we will do is target that death benefit based off of the appropriate MEC limit that we want or that they want. So primary limits to be aware of: insurance company limit and IRS limit. So if I say, hey, I want the ability to be able to pay in $100,000 per year, and I want a company that allows me to 10x my minimum base premium. What that means is I want to set my base premium at $10,000, my MEC limit at $100,000. I can easily commit to the minimum, $10K, and have the ability to add up to $100,000. I can maximize the cash value. So let's demonstrate very quickly with a smaller example. What we have here is a 40-year-old male with an insurance company, an insurance policy with the same company, same cash flow, same health rating, everything's identical here. But what's not identical is the cash flow, where we are directing funds. So again, same insurance company, same health rating, same outflow. If you're the client, you're the consumer, you're paying in the same amount, but have different results. We're looking at first $20,000 for 15 years. First example, we have a policy where we are paying in 20 grand with 100% insurance premium. So traditional whole life, what this means is of our $20,000, 100% of that payment is allocated towards the premium, what we refer to as the initial insurance expense. Meaning I pay that 20,000 in, and this could be 20,000, 2,000, or 200,000. You'll see very similar results. Nothing in cash in the first year. By year 2, I've paid in a total of 40,000, and I've got 3,000 to show for it. Not that attractive at all. As time passes, I see eventually I start getting more and more back relative to what I pay in, but it takes between 13 and 14 years just to break even. We have it highlighted in yellow here. At this point, I've paid in year 13, 260, year 14, 280. I finally have a gain on my policy. This is a traditional whole life insurance policy, which most individuals have been exposed to. This is what comes to mind when we think of whole life insurance. I've referred to it before as a great example of what not to do if we're interested in learning how to maximize the cash value. An advantage to this can be the immediate death benefit in long term. However, we never design policies in this fashion for individuals we work with. Then on the right, again, same insurance company, same cash flow, drastically different results. 20,000 a year. Cash value right off the bat, almost 90%. It's about 87%, 86, 87% here. What we did here was minimize the premium. So remember those two areas where money can go? You've got your premium, and then you have that PUA rider. So this example on the left, everything went into the premium. Over here, we minimized it based off of the limit set forth by the insurance company. We maximized the PUA rider relative to our cash flow, whatever we're paying in here. And that's where we have the bulk of our payment and cash value immediately. That's money we have access to. The break-even point we see between years 4 and 5, just about year 4, where I've given them $80,000 and I have $80,000 in my cash value. Now, both policies are set up to not trigger a MEC, the IRS limit. We designed both of these to make sure we never trigger a MEC at any point in time. Okay, let's look at a long-term comparison as we scroll down here. So in both policies, by the 15th year, and we can keep funding if we wanted to, or we can stop much earlier, but by year 15, I've paid in $300,000 in total. That's my total out of pocket, and that's the column we see in bold black. So we don't pay anything in after year 15. And what do you see with the cash? If we just want to pick, let's pick year 30, where I'm pushing 70 years old here. The traditional policy, I've paid in $300,000 over 15 years, let it sit and grow, and what happened? I've got a gain, $685.5 in cash value. Not bad, but that is over 30 years. If I look at the internal rate of return, the IRR, won't be super attractive there. Now, as I look at the maximum cash policy, what's so interesting about this, exact same insurance company, same out of pocket by the consumer, everything's the same, except we redirected where our money was going, and we had more upfront and more long-term. So $885,000, that's a $200,000 difference. With one tweak, redirecting cash flow within a life insurance policy. When we work with banks and corporations, when we put a policy together for a bank, it is designed for maximum cash value right off the bat, as it is a tier 1 asset on their balance sheet. So we can do something very similar for an individual, for anyone, and any agent can do this same setup here. It's nothing secretive that only we can do. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.